In the heart of the global financial system, there's a number that affects nearly everyone. It dictates the cost of your mortgage, your student loan, your credit card interest. For decades, this number was called LIBOR, the London Interbank Offered Rate. It was the bedrock of trillions of dollars in financial contracts, a number built on trust. But what happens when that trust is broken? Between 2012 and 2015, the world learned that this cornerstone of finance was a lie. A handful of the world's most powerful banks had been systematically manipulating LIBOR for years, rigging the game for their own profit. This is the story of the LIBOR scandal, a conspiracy that shook the financial world to its core and revealed a culture of greed and corruption. So, what is LIBOR? Every day, a group of leading banks would report the interest rate at which they believed they could borrow money from each other. The highest and lowest submissions were thrown out, and the average of the remaining numbers became the official LIBOR rate. It was a system based on honesty, but some traders realized that by nudging their bank's submission just a tiny bit, they could influence the final rate. And that's exactly what they did. Traders from different banks colluded, sending messages like "push the rate high" or "we need a low fix today." If their trading positions benefited from a slightly higher or lower interest rate, they would pressure their bank's LIBOR submitters to report a false number. A few basis points might seem insignificant, but in a market worth trillions, it translated into millions of dollars in illicit profits. During the height of the 2008 financial crisis, the manipulation took on a new, more desperate purpose. Banks were terrified of appearing weak. A high borrowing rate signaled that other banks didn't trust you. So, to project an image of financial strength, they lied, artificially lowering their LIBOR submissions to hide their true, dire situation from the public and from regulators. The scheme began to unravel as regulators in the US and the UK started digging. They uncovered a mountain of evidence, incriminating emails, chat logs, and testimony from whistleblowers. The scale of the deception was staggering, implicating some of the biggest names in banking: Barclays, UBS, Deutsche Bank, JPM, ORGA, and Chase, and the Royal Bank of Scotland, among others. The fallout was immense. Regulators imposed more than $9 billion in fines on the banks involved. It wasn't just a slap on the wrist. Criminal charges were filed against dozens of traders and brokers. In 2015, 5 major banks pleaded guilty to felony charges in the United States. High-profile executives, including the CEO of Barclays, were forced to resign. The scandal destroyed LIBOR's credibility. Regulators concluded that a rate based on estimates rather than actual transactions was too easy to rig. The decision was made to phase it out completely. By 2023, the world had moved on to more secure, transaction-based benchmark rates. The LIBOR scandal served as a harsh lesson in the fragility of financial trust. It exposed a broken culture at the heart of the banking industry and forced a global overhaul of one of finance's most critical mechanisms. While the fines have been paid and the system reformed, the story remains a stark reminder of how easily the pursuit of profit can lead to corruption on a global scale, with consequences that ripple out to us all.